The 80/20 Rockstars podcast is back and we're coming out swinging. I had a conversation today with Marissa LoCascio from 1031 Core. This is a really detailed, high-level conversation. I don't think I've ever had such a thorough conversation about 1031 exchanges with anybody in my life. She's very knowledgeable about the subject. This is very applicable. If you're trying to build a real estate portfolio and you're trying to avoid taxes, there's many ways that you can use a 1031 that people are not familiar about, including doing a reverse 1031 and buying a property before you sell yours, or buying a property of a lower value than the one that you're selling and making improvements to it. So we went into that and much, much more. If you own real estate and you're thinking about setting up your estate, if you run a business and you own the real estate where that business is at, and you're trying to figure out what you're going to do for retirement someday down the line, there's many scenarios where this process and this strategy can be useful. So great conversation. We went in depth about numbers and examples and sales price versus your actual proceeds versus your mortgage amount. And we talked about how the basis, what happens if your basis is higher or lower when you're selling a property, your tax basis. So again, high level conversation. I enjoyed it a lot. I'll break this down and put chapters so you can jump towards particular sections of the video. And if you have any questions, leave a comment. I appreciate you watching, and tune in for Marissa LoCascio from 1031 Core. Marissa, thank you for joining me today. I've been looking forward to this conversation because it's one of my favorite topics. So thank you for joining me today.
Thank you for having me.
So for those, most people who are watching this probably won't know anything about you. Can you just give me a brief, your background? How'd you link up with 1031 Core? Because I think you have the most amount of experience of anyone I've ever met that does 1031s, which is awesome.
Right. Sure. Absolutely. Marissa LoCascio. I am Senior Vice President with 1031 Corp. I have been with 1031 Corp for close to 21 years at this point. And I, oddly enough, don't have a background or any kind of education that you would think, oh, well, that lends itself to 1031 exchanges. I graduated from University of Delaware with a degree in criminal justice and ended up in 1031s. So it's tax law, right? It's related to tax law, and I just liked the law, period. So I ended up interviewing with Margo McDonald, our president, still our current president, and she definitely has been in the industry longer, and I'm pretty sure you've met her. So there you go. There's one more. But I started out doing just the basics, right? Handling the day-to-day, the client transactions, which really is the fun part, and kind of just grew with the organization. And now I do trainings and our compliance and all of that boring stuff. But this is the fun stuff when I get to do these.
Awesome. So for someone who doesn't know, what exactly is a 1031 exchange? Why would you do it?
Right. So the 1031 really is a powerful tax tool. And if you own any kind of real estate, it doesn't just have to be commercial. Of course, every single commercial property qualifies, right? Because it's business use or investment. But any kind of real estate that you hold for business use or investment, you can sell it and do the 1031 exchange and defer the taxes you would normally pay, right? Capital gains, depreciation, all of those, as long as you reinvest into more real property that you're going to hold for business use or investment. And you can really kind of use 1031 as that wealth building tool, build up your real estate portfolio, really get to those investment objectives utilizing 1031, because you get to take those tax dollars that normally you would have set aside for tax time, and instead reinvest it into the real estate, giving you greater buying power, right? You can see how that could compound over the years.
Absolutely. And before we dive into just, because most people, when they think about 1031s, they're thinking real estate only. I've even I, like, I'm experienced in real estate. I've heard you can do it with other asset classes or machinery and equipment. Have you dealt with that at all, or do you do that, or is it that rare?
So We used to. But unfortunately, the Tax Cuts and Jobs Act of 2017 actually repealed 1031 for personal property. So, yes, I have definitely done exchanges on really cool things like machinery and artwork and a violin and a bow. But unfortunately, you cannot do that any longer. So, as of right now, it is just real estate that you would be eligible to do a 1031 on.
Gotcha. Gotcha. I did not know that. So just
Yeah.
real estate. Okay.
Yep.
And it can be any type of real estate. Like, this is another question I think I've gotten recently.
Mhm.
Um, is there any type of real estate you can't do it with, such as like a primary residence? I just got this question yesterday, actually.
So, correct. You cannot do a 1031 exchange on a primary residence, but in reality, there's a way better section of the tax code for your primary residence, right? So as long as you've owned and lived in that primary residence for 2 of the last 5 years, you're eligible to take the primary residence exclusion, which is section 121 of the tax code, right? Individuals can exclude up to 250,000. Married couples filing jointly can exclude up to 500,000. So that doesn't have any reinvestment requirement. There's no time frames on it, nothing like that. You can take the primary residence exclusion every 2 years. So while, of course, I love 1031, can't do it on your primary residence. But the good news is you've got that way better section of the tax code.
Gotcha. This is a small in the weeds example, but let's say you had a primary residence and you had more than $250,000 of equity, and you already moved out, but it still does hit that 2 out of the past 5 years. This is the exact situation the gentleman I was speaking to with might have, like 900,000 in equity, let's say, for example. Then you've got that gap. You can, the first 250, you're good, but then you have another 5 or 6. Like, can you do both, or?
Sure, actually, that's a really great example, and you could certainly go back to whoever asked you that question. So one great strategy that we have seen is when those that have the great fortune of the last couple of years having lots of appreciation for their primary residence, if they have the ability to move out but still keep that property, you could certainly convert it to a rental, right? And let's say in 2 years, you decide you would like to sell that. You've been renting it for 2 years, and prior to that, it was your primary residence. When you sell that property, you are now eligible to take not only the section 121 for the primary residence, you can then 1031 the rest. So you can combine those two powerful tax strategies and kind of get the best of both worlds. You can take the 250,000 that you're entitled to for primary residence, walk away with that at closing, and have the rest go into a 1031. Now, of course, you have to be willing to buy into real estate that is then going to be business use or investment. So that's something they would need to think about and judge whether they'd like to do that. But it does save them from the tax hit that they would have taken on that, anything above the $250,000 exclusion.
Okay, awesome. So you are able to kind of combine both, as long as you're out and it's your property is being claimed as a rental, like it's no longer primary.
Right. Yep. And you still have to be within those 5 years for that primary residence exclusion, right? So those 2 years still have to be within the last 5.
Okay, it makes sense.
Mm-hmm.
So let's I'm going to zoom in on the actual process and like how it actually works when you do it. So let's say, for example, I bought a property for $1 million 10 years ago. Now it's worth $2 million, right? Which a lot of people are in that kind of position. So
Sure.
if you bought a property in 2014, 2015, and just for even numbers sake, let's say you took the depreciation for 10 years. Let's say the basis is like 800, right? 800,000. And now I'm going to sell it for $2 million. When do I reach out to a company like 1031 Core, and like, how does it actually work before closing? Like, when do you have to decide whether you're actually going to put the money in exchange, and what's the process?
Sure. So honestly, most will reach out to us once they have that signed agreement with a buyer for the property that they're selling, right? Because at that point in time, they feel like it's probably likely that they're headed towards closing, things are moving forward. You can absolutely call us before that to kind of figure out what's the 1031 all about, what should I expect, what are my time frames, all of those good things. But usually that signed agreement is the trigger for people to call us, and then we can start putting together paperwork because we want to make sure that they have ample time to review that. And we want to make sure that whoever is handling closing for them, that we loop them in so that they're aware that it's part of a 1031, right? Because it does ever so slightly change their process for closing. So we don't want to dump that on them last minute. I will add, if there is someone that, maybe we're talking to them and they thought, gosh, I am not sure if I'd like to do the 1031 on this particular property. And initially they say, no, I don't, I'm not going to do the 1031. And then they decide a few days before closing or at closing that they would like to do the 1031.
Yeah.
We can still get it set up. We do need a couple of things. We need a copy of the signed agreement, copy of the title, and we need to have a conversation with that seller to make sure, what the 1031 is all about and what you are kind of getting yourself into there. But we can still get it together as long as closing hasn't occurred and the seller hasn't officially given up legal title. Because at that point in time, it is too late to do it.
Okay. So once they sign the settlement sheet and the money gets wired to them, you're done. Right? Okay.
Correct.
Got it. But it's not, if someone does decide to change their mind before closing, it could be done. It could be expedited, let's say. Okay. And so when an when an exchange, let's say it's the day of settlement, they've just closed. Now the money is going to be wired to your guys' company, like as an intermediary, for example.
Yes.
Okay. What happens with, I also had someone ask me like a kind of basic question, an older gentleman not too long ago. He's like, how do I know what's going on with the money? How do I know the company's not going to steal my money? Like what securities, how can people be reassured that it's actually a legit process? Because there's a lot of intermediaries out there.
Absolutely. Great question. And that client and everybody should be asking all of those questions to any 1031 company that they are contemplating working with. What are the security measures that you have in place for my funds? So our security measures would probably go a little above and beyond because quite frankly, although we're in the business of handling 1031s and being the qualified intermediary, our more important job is safeguarding those funds while they're with us. So the way that we do it is we actually set up a segregated FDIC insured account with their name and tax ID attached to it. Anytime there is a movement of money, if they need anything, a deposit, an acquisition of a property, we require signed and written authorization with verbal callbacks to even begin that process. And after that, it requires 2 additional internal authorizations on our part. We also offer 100% FDIC insurance with a program called ICS, which is Insured Cash Sweep. So if you are going to have proceeds that exceed the $250,000 FDIC insured limits, we will offer that as an option at no additional cost. It will not cost you anything else to have your funds 100% FDIC insured. That way, if something should happen, God forbid, with any of the banks, your money is still good to go. And you do want to make sure, just kind of generally on another side note, as far as researching any 1031 company that they're contemplating, they're comparing fees, they're doing that sort of thing. Ask how long they've been in business, right? And what additional safeguards do they have? Do they have a fidelity bond? Do they have errors and omissions insurance, right? Are they a part of our National Trade Association, the Federation of Exchange Accommodators? all of those things would factor into some sort of comfortability level. And one last note on the funds, we actually give our clients the ability to view their account online at the bank's website at any time. Not a lot of QIs do that. Because it's additional steps and it's additional work, but we feel like that gives a little bit of transparency as far as here's your money. If you want to log on at 2 a.m., by all means, go for it.
Awesome.
Yeah.
So you mentioned a few things there. The first being 100% FDIC insurance on the account. That's something that someone can decide to opt into if they want.
Absolutely.
Is there, I guess, a reason why someone wouldn't do that, or it's kind of like,
It's kind of crazy. We offer it, right, to anybody that we go, gosh, you're selling for this amount, and based on your mortgage payoff, it looks like you're probably going to be over. We offer it, and some people go, nah, I don't want that.
yeah,
I don't know why they would opt out. Because like I said, we're not charging them anything extra. Like it's
right.
not, it's no additional headache. The only additional paperwork is that we will ask them what other financial institutions they may have accounts with that same name. So if it's, them individually, we need to know the other accounts that they have money, because if they have an account at another bank, let's say they have money at Wells Fargo. Well, we don't want the ICS program to utilize Wells Fargo because they've already got money there. And if they get pushed over the $250,000 limit, well, now we're in trouble with those funds there. So we will simply ask for that additional information. That's really the only extra work, if you will, as far as their end is concerned.
Gotcha. There's no lot of heavy. It's not like a heavy lift of paper for
Not
verification.
at all.
Okay.
Not at all.
And also, is there a maximum limit to, let's say someone's putting $40 million or something, if it's a sizable property, is there kind of a max limit to that?
There is not. It would take quite a few banks to spread out that amount of money, but that is how it would work. They would simply spread it throughout those additional financial institutions to make sure that they didn't go over the 250.
I see. 1031 core, you mean?
It would be the ICS program that
Okay.
they would do the actual legwork and logistics of that. We do not choose those financial institutions, but they have to participate in the ICS program.
Cool. Good to know. I never knew that. I mean, that's because it's a legitimate. There's plenty of people out there who have businesses that are, with real estate that's worth 10, 20, 30 plus $1 million, and that's a real thing. So, and then the last thing I think you had mentioned there was you have to make sure that the 1031 company has E&O insurance, which is, does that cover for, God forbid, a company like stole the money, right? Is because I know many insurances like don't cover for theft. Like, is that's really what people are asking when they're saying I'm worried about my funds. Like the FDIC is one thing, but what happens if there's an employee that gets access to an account or something?
Right. So errors and omissions is, if we were to make a mistake or there would be some sort of, untoward employee.
Right.
Or and the fidelity bond, that's more if we were to go bankrupt, right? Like that's that level of insurance on that end.
Gotcha.
So yes, and they do, they want to ask all those questions and make sure that this company that they're working with took those steps, right?
Sure.
Those insurances aren't cheap, so you want to make sure that they are doing what they can to make sure that if something should happen, that they're covered and that their exchange is, going to be completed no matter what may happen during the transaction.
Awesome. Okay, and thank you for the clarity. It's very helpful. So, I think that's all the questions I had there. So, let's say I back to this example. I sold my property for $2 million.
Right.
My basis was 800,000. Let's just say I don't know. Let's say I owed 500,000, which is for even numbers' sake. So I would be walking away with $1.5 million. cost, right? Um, what's it generally gonna cost me? Number one, to do ballpark. What does it cost to do this? Does the cost change a lot based on how much money you're doing it with, or is it kind of fixed for the most part?
Right. So it is mostly fixed, right? It's based on the contract sales price. I'll give you two of our tiers for the fee schedule. So if you are selling for $1 million or less, it's a flat fee of $1,250. It goes up when the price goes up. So the next tier is $1,550, and so on and so forth. It's not an insanely high fee. That fee does cover the sale of one, followed by the purchase of one. So if somebody did decide, I'd like to buy an additional property, I want to split my funds into 2 replacement properties, at that second closing, it would simply be a $300 additional property fee.
Gotcha.
Yeah.
That's very affordable considering what this process is and how much liability and risk and money is moving, right?
Right. And that that tax consequence probably heavily outweighs what that fee is.
Sure.
Generally, it does. And that fee does go right on the closing statement. So it gets paid from the proceeds. Closing agent cuts us a check. Nothing to worry about outside of closing.
Easy enough. So that answers my next question, I think, which is also important for people to think about. If you decide to, because I'm making an assumption here, if you decide to put your money in a 1031 exchange and then you don't end up buying another property, it kind of just goes away. So they're like your maximum risk, let's say if it's less than $2,000 to potentially save yourself hundreds of thousands on tax, it sounds like a very good idea if you're selling anything large, just to at least put it there and think about it for a little bit if you're not sure you want to pay the tax.
Agreed. Absolutely. Yes. I mean, you are correct. The fee would be non-refundable. So, you do the 1031, you sell your property, funds come to us, and, you get to day 45, which is one of those time frames that you have to meet, and you don't end up identifying or buying anything. You would be out the fee that you paid us, but it certainly is worth it to give yourself the chance to potentially find that property, right, that you want to reinvest into. Agreed.
Right. And so, we'll talk about the timeframes in a second, because I do have questions about that. But let's say, so now we're at closing. Let's say we paid the $1,500 fee, identified 1 or 2 properties, and now the money is in escrow at 1031 Corp.
Sure.
How much? What do I have to find in this example that I sold for $2 million, my mortgage was for 1.5, but my basis was for 800,000, right? Because there's those 3 important numbers. How big of a property do I have to buy? This is something I don't understand. If I'm walking away with $1.5 million, but my basis isn't in, like, you know what I'm saying? Like, the difference between my basis and the sales price is only $1.2 million.
Yep.
Do I have to? People say you have to buy up. You have to get a mortgage as big. Like, can you clarify that for me, please? Like,
right. Yeah. So definitely are quite a few misconceptions regarding how much you actually need to reinvest. Some think it's just the amount of their gain or just the amount of their equity they get from the sale, and neither of those are true. That'd be great if it was just the equity, right? Because you do a refi, pull out all your cash, and then sell. But that is not the case. So the general rule is that you want to reinvest equal or greater value and equity. So let's use your example. You sold for $2 million. And you do get to subtract off closing costs. So I know in our example, we were pretending like closing costs didn't exist, but for this example, we do need to factor that in. So let's just say, we had, for ease, right, 100,000 in closing costs. Probably going to be maybe more than that, but maybe not. So closing costs are things like real estate commissions, transfer taxes, if those exist in your state, the charges that the title company charges you, those sorts of things. Your mortgage payoff, not a closing cost, right? So we sold for $2 million, and now we've got $1.9 million that we need to reinvest. So we subtracted off that 100,000 of closing costs. So we want to look for a new property that's worth 1.9 or more to really maximize our tax savings. That $500,000 mortgage that you paid off, that is that value piece that I'm talking about. So, the equity that you get from the sale, all of that cash, that equity does need to be reinvested into the new property. And that $500,000 mortgage that you paid off, you can either go and get a new mortgage for $500,000 for the new property, or if you wanted to just get cash from another asset that you own and bring $500,000 to the table to offset that mortgage that you paid off, you can absolutely do that too. IRS doesn't necessarily care how you get to the 1.9 as long as all of the cash gets reinvested and you didn't walk away with any cash, right? So those are kind of the two important factors there.
I see. So just to clarify, because it sounds like the word equity is different from what I was thinking it was. And again, in this example, because for people to follow along with the numbers, we sold for $2 million. You're walking away with 1.9 after closing costs. The mortgage is $500,000, right? And you're saying you have to put 500, but in this example, you'd be walking away with 1.4 in cash.
Yes.
But you only have to, if you were buying a new property for $2 million, let's say, you only have to put 500? Or
you would have to reinvest 1.5 or 1.4 of that cash from your sale.
Yep.
And you would have to make up the difference of that 500,000, right? That was a mortgage payoff by either getting another mortgage for the 500,000 or contributing cash.
Okay, so then it is kind of, I had it flipped in my head. So you do have to reinvest all your funds and get at least the same amount of mortgage. So there's no way you're walking away with any money or whatnot. But if you bought a property, let's say for $3 million and you put 1.4 and you got a mortgage for 1.6, that's okay. You could do as big as you want. But just to drive this one home, you couldn't buy a property for $3 million and only put $1 million down. I mean, you could, but you're not going to get the full exchange, right? You have to put all the money from the previous sale.
Correct. Exactly. If you end up with cash left over at the end of your exchange, that is what they call boot, and you would end up paying taxes on it. Yes. So you could choose to do that. And sometimes we have folks that do, but they think, gosh, you know what? I actually am okay with taking the tax hit on this 400,000 because I'm still deferring, whatever taxes they had. So sometimes it's an on purpose decision that they will make. Yep.
Okay. Awesome. And this helps a lot. So let's think about another situation then when the person does not have that much equity. We spoke briefly about, before we got on here, about doing a, a cost segregation study. So like, let's say you bought a property, again, you bought it 10 years ago. What did I say? $1 million, it's worth $2 million. But 2-3 years ago, you refinanced. So you have a mortgage for 1.6, right? Somehow somebody gave you 80%. And you over leveraged because they thought it was worth more. That so many people were in this situation. They thought it was worth 2.3, 2.4, 2.5. I'm gonna give you 1.6, and now it's not really worth as much as I thought. I'm only walking away with, in this example, the 2 million minus the 1.9, you'd be walking away with, let's say, 300,000, right? If I was looking to do an exchange and buy another property, I only have 300, but I still need to get to the 2 million number. How does that work?
Correct. In that situation, the same rules apply, unfortunately. So, there's often times where we have somebody who doesn't have a whole lot of equity. I remember a lot of years ago, I actually had someone who owed money at closing, but still needed to do the 1031 exchange because they had done a 1031 into that property and they had a boatload of depreciation that was associated with that sale. So if they had done an outright sale, they would have taken a huge tax hit. So there are times where on the surface you may think, well, I'm selling at a loss, or I'm selling for the same price I bought this for. But because of factors like depreciation, maybe due to a cost segregation, that could be a factor, you still should do the 1031 because you will then not be on the hook for paying those taxes, right? And whatever equity you are walking away with still needs to be reinvested with those rules we just talked about. That all of that equity needs to go into a new property, and that value, right? If that 1.9 is your target price you need to buy for to really maximize your tax savings, you're still on the hook for reinvesting that 1.9, even if you only have 300,000 of equity.
Wow. Or zero.
Or zero equity. Yes.
In that case, I mean, they're not even getting any money at settlement. It's just kind of like more they're doing paperwork and just processing the exchange, but no money.
Yes.
So if that's the case, and they're not getting money from the sale that you're holding, the new property that they buy, do they have to wire that money to you and then it goes to the title company?
No, we would just document it as part of the 1031 exchange, but they would still just wire the money directly to the closing company. Yeah.
Okay. Gotcha. So it's not too different from a normal sale. Okay. I mean, and it's I don't want to say it's a terrible situation to be in, but that's a rough situation to be in. But there are many people in that kind of situation right now. So basically, just to recap, if you're selling a property, then the gross sale price minus whatever costs, you have to take that value, and that value or more is what the new property you have to buy. However you get there, cash, mortgage, it's that whatever. And then obviously the biggest caveat is whatever cash you walk away from closing from the property you're selling, that has to go in, however big that or small that number is.
Yeah.
And the basis of the property has nothing to do with really the value of what it's just strictly based on the sale price.
When you're trying to figure out how much do you need to reinvest to maximize tax savings, yes, correct.
Okay.
When we have instances where someone is trading down in value, like let's just go back to our example of our 1.9 was our target we wanted to hit.
Yeah.
Let's say somebody they just can't make that number. They just simply can't. Maybe they can only buy for 1.5. What would end up happening is they would pay tax on that trade down, or that, what is it? What did we say? 1.9 and 1.5, $400,000 difference that they did not reinvest. So it doesn't make the entire transaction taxable. That is something to keep in mind, for those that might be in that terrible situation where they only have 300,000 of cash they walk away with, right? And a huge mortgage they paid off.
Yeah.
Maybe they could get to 1.5. And the bigger that trade down is in, various situations for different clients, that's people should always talk to their tax advisor before they go doing something like selling a piece of real estate and potentially bringing that tax consequence on. But when we hear numbers that are really far apart, I mean, we jump up and down. We don't know your whole tax picture, right? You're giving us these numbers, these round numbers, and we can give you the rules and how it all works and all of those good things. But at the end of the day, your accountant's going to know best what you should do and whether it's still worth it. Should you have a huge difference between the value that you're selling for and what you were hoping to buy for? I had somebody tell me they were selling, this was a lot of years ago, but they were selling for 1.2. They only wanted to buy for 300,000.
Yeah.
And I said, okay, well, it depends. How much did you originally buy the property for? And they had originally bought it for 800,000. And I'm like, it's not worth it for you to do the 1031 in that instance, unless you have some crazy factors I don't know about, right? Which, again, check with your tax advisor. But based purely on those numbers, it simply doesn't make sense. But, it's not our call. So we're happy to help and talk through it all. But Um, you know, we want to make sure they know the rules and how to get there and how to really maximize it.
Oh, yeah. Well, when you start playing this game of like deferring taxes, whether it's through cost seg or 1031, it can get really complicated really quick. And like
Sure.
even myself, until a few years ago, like I had I had a triplex in West Philly that I sold a couple of years in 2023, and luckily this is small numbers, but purchased it, did rehab to it, but my basis was basically lower than I thought, and I never asked my accountant. Be like, for anyone listening, if you don't ask your accountant for your depreciation schedules every year, because they'll send you your taxes, all that information's in there.
Mhm.
It's just gobbledygook. My tax returns are 150 pages long. I'm not really going to look for that. Like asking them to specifically send you your depreciation schedules. Where am I at with the IRS with each property I own? If I sold it today, minus the closing costs, that's the difference, right? Of what I'm going to pay taxes on. I'd never done that before, and I'd say most of, well, like many people I know, some who own several dozen properties, like never had really done that either. And then you can get caught once you sell something and it's for too much, and I'd refinanced it and didn't have any equity, and except I still ended up with a tax bill, which was like really scary on more than what the money that I walked away with.
Yeah.
So yeah, like buyer beware. This can get, you really have to plan your life and your tax situation out very carefully doing this, very carefully.
Yes. Nope. That's great advice. Absolutely.
So, time frame, real quick. What exactly is, and then I want to talk about potentially you're doing a reverse 1031,
Sure.
which would be so, bonus for people who may not have heard about that. If you sell a property the day you close, what happens after that? How long do you have?
Sure. Yes. So, date of closing, right? Your what we call your relinquished property or your old property, that triggers two time deadlines. The first is a 45-day identification period. So within 45 days, you need to give us a list. Here's what I want to use to complete my 1031. From that same date of closing, you have a total of 180 days to get it all wrapped up and go to closing on one or some or all of the properties that you put on that 45-day list. I will say the 45-day window is probably the most stressful part for our clients and their real estate professionals, because let's be honest, you're trying to help them find that perfect property. And so, there's some things to keep in mind with that 45-day window. Once midnight of day 45 comes and goes, whatever you have on that list, that's what you have to choose for. IRS does not allow for any substitutions, alterations, or changes after day 45. The other thing, kind of just some good advice. We've seen a lot of people getting the property that they would like to buy under agreement before they even list their current one. That's been a trend as of late. There is nothing that says you can't do back-to-back closings. The dates that are on your agreements of sale do not matter. It's settlement dates and closing dates that matter. So, you sell your relinquished your old property on a Tuesday, you go to closing on your new one on Wednesday. Great. You are done your 1031 in a matter of 2 days. And that is perfectly fine. We can absolutely work with that. Certainly takes the stress out of that 45-day identification period. But it's not always something that you can get under agreement, right? And
Right.
that may not always happen. And then you somewhat end up in the situation of, well, what happens if, gosh, my buyer falls through, but I still need to buy this new property, right? Which enter reverse exchanges.
Right. And before we dive into that, does the
Yep.
45-day time period start the day after you close or the day of closing?
Day of. Yep.
Day of.
And there is, in case you were trying to gauge when that might be, if you have a proposed closing date, we have a calculator on our website. You could just pop in your estimated closing date and it'll give you your 45 and your 180. Then you at least have an idea of what you're working towards. So yeah.
Sure. And then how many properties can you identify?
Sure. So there are some rules that go along with the identification. The first is the three property. You can identify as many, it's up to three properties, regardless of their combined value. If you decide you would like to identify more than that, right, 4 properties, 7 properties, whatever it is,
Yeah.
your total value when you add up all of those properties together can't exceed twice what you sold for, or 200%. So, let's just say you sold a property for 2 million. If you wanted to identify, let's say 7 properties, right? You could do that as long as when you add up all 7, the total value of all of them does not exceed $4 million.
Awesome. So it's based on the sale price, not the amount that your exchange is based on, which
Correct.
like the one, it's based on the 2 million, not the 1.9 that we talked about.
Yes. It is contract sales price. Yep.
Great. Did not know that. Okay. So the magic situation that we're talking about, and for those watching, pay attention because I didn't know much about this until recently either. If you follow what Marissa mentioned and you try to line up a property for you to buy before you sell yours, and God forbid your buyer falls out of contract, but you have $100,000 hard and you really want to close on that property because it's a good deal. There's something you can do to make this work without paying taxes. So you don't have to do the traditional sell, put in an escrow, and then buy. And it's called reverse 1031 exchange. Now, how does that work?
Right. So the reverse can really come in and save your ability to do the 1031 exchange. So in our scenario where your buyer fell apart and that seller of your new property is not willing to wiggle on a closing date, they won't let you push it back. You could elect to do what's called a reverse 1031 exchange. High level, the way that it works, we actually create a special purpose entity, typically an LLC, to take legal title to that property for you using money that you loan to that LLC. Our sister company, Reverse 1031 Corp, would be the one to handle that particular transaction. And those same time deadlines that I talked about with the regular 1031, they actually apply in the reverse as well. So from the date that what we call park that new property for you, you have 45 days to tell us what you're going to sell, which in most cases is easy for some. Although I will say when some people have quite a few properties that they own and maybe they've got multiple listed, they're not sure which one's going to sell, right? So they may list multiple. And then from that same date that we parked that property, you have that 180 days to get that old property sold and closed. And then we will convey the parked property back to you. So there's a couple of considerations with the reverse exchanges. They are more complicated and they are more costly. But depending on your tax consequences, it certainly could be worth it to do that type of transaction. And it is truly 2 actual real estate closings that are occurring. Once when we park it, and then once again when we convey it back to you. So if you are contemplating doing that in the state of Pennsylvania, something to take into consideration, transfer taxes, right? Depending on the price of that property you're having us buy and park for you, it starts to add up those costs, right? So it certainly is a great strategy when you are somewhat backed into a corner and you do need to go to closing on that new property. But I will say there's other times where it's not that they were backed into a corner, it's that it actually served their business needs and the reverse helped them get there. So a good example of that would be, let's just say someone has owned a business, maybe they've got a couple of warehouses, they've owned it for 30 years. And 30 years ago, his property was perfect. It definitely accomplished all of their business needs, but they've grown and they are not as close to the highway entrances, exits as they'd like to be, but they can't just stop doing business because they sold their old property and now they're on the hunt for a new one. So in that instance, it would allow them, the reverse would allow them to find that new property, right? Maybe they need to make a few improvements to it, right? There is also a reverse improvement exchange. You can make improvements while we are entitled to it. That's an option. They get it ready to handle business. They start moving their operations there. All the while, they have their old property on the market and they're trying to get that sold and closed. And then once that happens, they now will acquire the property that we parked for them in the reverse, and they're operating their business as usual, and everything was a smooth transition. So it can come into play in an intentional way as well.
Sure. So many things to unpack here, and that was all. No, this is a high level conversation. I think it's many people I think are going to take a lot of value from, because most of the people I'm calling are business owners that are struggling between when am I going to sell my business? I've got 20 employees. How am I going to make it all work with keeping operations smooth and expanding? I have several people like on my pipeline right now who are going through this problem. So, quick questions first. You mentioned the rules are kind of the same with a reverse 1031. You sell, you have 45 days to identify. Sorry, you buy, then you have 45 days to identify what you're selling. Is there a same kind of value thing where do the values matter what you're selling, or 200% rule applies?
Yep.
Okay.
Yep. The same rules apply. Correct.
Okay. Cool. Because this really applies, like you said. Like I'm working with a few people right now who have significant residential portfolios. And if you have 20 duplexes and 40 houses, and you're trying to figure out which ones to roll up into a bigger property, and you don't want to pay tax, you have to think about this. So you can only identify properties you're selling. The value of those have to be 200% or less of what you just bought with a 1031 exchange. Okay. So if somebody decided to do a reverse 1031, but similar to how you could cancel a normal exchange, let's say they decided to not sell their other properties.
Sure.
That special purpose entity that's created, do they just take ownership? How does that work? And what tax effects are there, if any?
Right. So we will hold title to up to the 181 days, because we'll do it for the full 180 that you were potentially trying to get that old property sold and closed. And so then we'll convey title back to you. And at that point in time, you own both properties at the same time. And there really there's no tax consequences as far as, because you didn't sell anything, right? There wasn't anything that you sold to warrant a tax consequence. So at this point in time, really, you're just owning both properties at the same time. Now, what that does do when they eventually sell their old property, that property that we had parked for them, if that didn't work out and we conveyed it back to them, that's no longer an option to include if they choose to do a regular 1031 when they eventually sell their old property, right? So they would have to find something new to reinvest into.
Really? So if you try and do this and you buy a property under a special purpose, you can never use that in a 1031.
Well, I mean, if you eventually sell that property after owning it for a period of time, absolutely, yes. And it's investment at that point in time, yes. But you can't. So we have a lot of people that the reverse fails.
Yeah.
We convey title back to them.
Yeah.
But they still have that old property on the market and they still want to sell it and do the 1031. But because that reverse failed for the one that they wanted to acquire originally, that one's no longer an option. So they still have the ability to do the 1031 on their old property,
right,
that they still own and owned during the reverse, but now they have to find something else to reinvest into.
Makes sense, because now you own it already, right? So that's why it's not an option.
Correct.
And last technical question based on the property transferring back.
Mm-hmm.
Are you collecting double transfer tax then? Because if it's really so, okay, which is a lot. If this is in PA, 4%, that's a lot of money on. Okay.
So there is a strategy. It's referred to as an 8911, where we could reduce the transfer taxes, but it is, I know I said reverses are complicated. This is even more complicated.
I know what you're about to say too.
But it could, depending on the price of the property, it could make a heck of a lot of sense to do that 8911 election. And you would basically be paying the 11% of the transfer taxes instead of the full 100%. But that is only if they are able to do a membership transfer. So it effectively is a 100% membership transfer instead of a deed transfer, which is the typical way real estate to get transferred. That's all something we would certainly talk through. Our reverse team would make sure they explain, like, listen, this is how it works. So in that instance with the 8911, there's some requirements on the back end. You have to keep those LLCs for a period of time. Like, there's just some additional things that they would want to be aware of before they decide, yes, that's the way I'd like to do it.
Okay. So basically, you have to have obviously you have to talk in depth about your situation, but to give some people perspective, like, let's say if you're planning to buy a $5 million property, in a reverse 1031 while you're selling something, if you're in PA, the transfer tax on that could be $200,000 plus.
Absolutely.
If you're following the strategy that you're mentioning and you're able to kind of transfer the shares of ownership of an entity instead of the actual property, and if you're saving 90% of 200, it's $180,000, but it's a huge difference.
That's a huge difference.
And so but you wouldn't want to do that if I'm assuming there's rules around, like, if you're going to be selling it again or something, or you're going to be you probably can't transfer ownership too many times within a certain period of time. There's probably things like that, I guess, that people need to know about.
Right. Well, I mean, in general, with a 1031, you don't want to be planning to sell it too soon after you acquire it anyway, right? You want to establish that good holding period. It's not all about the length of time, but it does factor into it. It's also about what was your intention when you acquired it, how'd you report it, how did you use it, all of those good things. So that all factors in as well. But there are rules as far as the LLC and being in existence and reporting for those LLCs for a period of time after that election, that 8911 election.
I got it. So it's not like you're not gonna make an LLC, do all this crazy stuff, and then shut it down.
And just get rid of it, right?
Yeah. Okay. Which I'm sure there's probably been people in the past who've done that. So okay.
Well, I don't want to know about it.
Right. Awesome. Well, this is super helpful. I mean, this is a high level conversation, and these kind of situations become very common when you own a business and operate it in a property, for example. Yeah. So.
And, one other thing, just one other comment, because you said you're talking to a lot of business owners, right? And maybe they've owned their property for 20 years, whatever it is, right? And they can't just move their operations. But if you do have some that are in the situation where, maybe they're starting to look toward retirement.
Yep.
And assuming that the property that they own currently, let's say it's, they own an auto body shop and they've owned it for 20 years, 30 years, whatever it is. And they are thinking, I don't really want to reinvest into another commercial property, another auto body shop, which might be something they're thinking because maybe they heard over the years this one thing here and another from somebody else. And they're assuming that they have to reinvest into more commercial real estate. They don't. They can certainly reinvest into a residential property. And something for them to consider is they could reinvest into a property that they would eventually like to retire to. So let's say they sell their auto body shop, they do the 1031, and they buy a new property and maybe other investments. And initially, yes, that property that they acquire in Florida, Arizona, wherever they buy, right, that they would like to retire to, yes, does have to be investment initially. But there is nothing that says they can't eventually convert it to strictly a personal use property. Move into it, just use it with your family occasionally, right? For the first, conservatively 2 years, they would have it as that business use or investment, but they can convert it, move into it, retire. So something to keep in mind that maybe wasn't initially apparent to those that have the commercial properties and they would like to retire.
That is huge, and that exact situation is how many people end up protecting a lot of their wealth.
Mhm.
Well, they'll do that. Their final 1031 of their life will be from this kind of big business, where maybe into a nice big house in Florida somewhere that they're going to write off in the sunset. And then if they eventually pass, that basis gets reset, and voila, you're not paying taxes. Even if you sold it the next day, you're not paying any taxes on it, any capital gains taxes on it. So
That's right. Yes, correct. Yep. They get the step up in basis, the capital gains, the depreciation, that all gets wiped away. And for 2025, the current estate tax exclusion is 13.99 million. So they've got a little bit to work with, right? Their heirs, if they choose, could go out and sell that property the next day and not have tax consequences as far as capital gains and depreciation.
we're up to 14 million.
Yep.
Gotcha. Why?
State taxes, yeah.
For estate taxes. Okay.
Yep.
This is fascinating. Is there anything else that I haven't asked about that people should know about 1031s? We went through a lot of situations. Is there any changes coming to the legislation, which I've heard? What do we need to know?
Right.
We're getting into it.
Right. So two things. One, I'll mention the last big rule that there is for 1031, just so that it's out there and everybody hears it. It's called the same taxpayer requirement. So basically, however you currently hold title to the property that you're selling, that's how you need to buy. Okay, so if you sell as an LLC, you need to buy as that same LLC. The whole same LLC. Yes, right. You kind of have to think about it. You're reporting this to IRS. So they've seen this tax return that has a specific tax ID on the top of it, right? They want to see that same tax ID reinvested and completed the 1031, right? So they kind of think about it that way. So that's something to keep in mind when completing the 1031. For some, it's not a big deal. There are those times where maybe they sold as an LLC and they would like to buy as a different LLC because they have it in another location and it doesn't make sense to have it be, they named it the street address, but then that's what the LLC was. So in that instance, what they could do is when they create that new LLC, the LLC that sold the old property would become the sole member of that new LLC. And they would elect to have that new LLC treated as a disregarded entity, right? So that it flows through, and ultimately the tax ID of the old LLC is still reporting it, but now on the title, the deed, all of that stuff, it's a new LLC name.
Wow.
So something they could noodle.
I don't think many people are going to appreciate what you just said there. That it's a very, very intelligent way, I think, of couldn't get it, and completely legal, obviously.
Oh gosh,
yeah. That's a very good piece of advice. That's a gold nugget there, because this happens all the time. Where if you have, especially, we haven't talked about it. If you have a partnership and you're selling property, and let's say one partner, I'm just making this assumption, but like if you have one LLC that's a partnership, and let's say you wanted to divest the partnership, and this is a situation you want to talk to your accountant, but if you're shutting down a partnership and selling the property, but you still want to 1031 to something else, maybe one person will sell the shares to the other person and you'll still use the same LLC, but you wanted to make something new, right? I'm assuming people would do it in that instance.
Right. Yeah. So there are times where they kind of want to rearrange the makeup of an LLC, and you could certainly do that before, during, or after the exchange. What you want to be careful of is that if there is an exiting partner, that you're not using the sale proceeds to pay that exiting partner. That can cause issues, right? So that we could probably do an entire podcast just on that topic on its own, because there are some strategies to still make the 1031 work. And oftentimes they don't want to keep the entity intact, right? They want to just completely get rid of it. And there's some, it throughout the industry, there's different opinions on how to go about that. So that really would be a tax advisor, legal advisor that needs to come into the mix and kind of help guide that conversation. Or we could certainly put out there all the different methods that we've seen. But in the instance where you said the LLC stays intact, you can mix up the partners within it at any time and have that LLC still complete the 1031 and then buy in that new name, right? Have the old LLC as the sole proprietor or sole member. Yeah, absolutely.
I could totally see where this gets down a rabbit hole, because that kind of brings up the next basic question that brings up is, if could one person who has, let's say it's a minority part of ownership in a property, and that property is sold to a new entity, somehow they wanted to keep a minority portion of ownership. Is that even possible?
So the old LLC and the structure that went along with it would still be intact if they weren't messing with the percentages. So that would still be in existence. Whatever their operating agreement said for the old LLC, still the operating agreement for that LLC. Now, if they change the ownership structure within that, then obviously that's a different story for that particular minority owner. Sure. But it wouldn't, the 1031 wouldn't come into play as far as what the operating agreement says for that particular LLC.
So if I own 10% of a property and let's say theoretically it was sold to another entity, but I only own 5%, I can't even think of an example of maybe where this would be. I'm assuming on like a larger level, this might happen though. Like if a corporation had, if there's an owner with a small part and they sell it to another corporation through a 1031 somehow, or would that never even happen?
Well, so the percentage of ownership, right? The LLC is the entity that owns the real estate, not the individual members within the LLC. So the individual members get governed by their operating agreement, not by the 1031 piece where they sold and bought. And there wouldn't be that old LLC, right? It wouldn't be changing as far as being in existence and having whatever operating agreement they had on the old one still governing what they're entitled to, how much they own, that sort of thing. So, that's more of a, they need to get into some conversations with attorneys to help guide how that's going to shake out, what it's going to look like, what they're entitled to, anything that changes, that sort of thing, right? Because that's as far as 1031, you just need the same tax ID to be reporting things.
Okay. And, in one final, I guess, thought on this, I could see that becoming you getting in the situation if, like, let's say two partners decide to bring a third partner on, and but they also kind of maybe want to cash out some, which I guess you can't. But anyway, I'm just thinking, like, if you want to bring another partner on and you sold the property to the new partnership, but I guess you would still have to buy a different property.
Right. If the partnership sold the real estate, the partnership would need to buy new real estate, regardless of how they mixed up the partners, if they did.
But then they could still have partial ownership in the property with the new entity, and they could go buy, they could take the proceeds and buy whatever else they want to do in exchange.
Wait, say that again? So
So like if I own, let's say it's $2 million example, say I own it 50-50, and we for some reason want to bring on another partner because we're going to develop it or something, which happened, right? And we sell it to this new partnership for, let's say it's 2.2 or something, whatever the number is. We would be walking away with proceeds, whatever it is, and we would go reinvest that into something else. Let's say it was a property that we weren't going to develop. We just want to hold it, no headache, right? Give me a 7 cap somewhere in a good area, leave it there. This new partnership would now own it for a little bit of a higher price, except there's 3 partners now. So this is getting super in the weeds, I know, but I could see this. I've had conversations where people have properties that they don't want to develop themselves. They just want to cash out some, and they want to take that money and do everything we've talked about. Maybe buy a residence, whatever, and then the new partnership, they'll retain a little bit of ownership, and then the GP will be responsible for kind of running the project and turning it into whatever they want to turn it into.
Right. Yeah. So, when it comes to the 1031 and executing it and staying within all the rules, right? So let's put some actual names to these LLCs we keep throwing around, so our partnerships that function the same way. So we sold our $2 million property. That was titled as Ross Properties LLC.
Yeah.
And that's how we've been reporting it. That LLC has 2 members currently, and our LLC files a tax return. You get a K1.
Right.
So we do the 1031 exchange. The new property we would like to complete, but the new property is in a totally different area, and we don't want it to say Ross Properties. We want it to say LoCascio Properties LLC. So what we would do is LoCascio Properties LLC would get formed. It would be a disregarded entity. The sole member would be Ross Properties LLC.
Right.
The operating agreement for Ross Properties LLC, in the meantime, we started to mix up the members. So now it's not just 2 of us anymore. We brought a 3rd person in, and now those distributions and whatever else you've got going on, the capital contributions, all of those good things that go into an LLC operating agreement are slightly different. But for the 1031, we're still that same Ross Properties LLC tax ID on both sides. So you're not selling to another entity in that instance. You're just acquiring the new property in a slightly different name, but with the same tax ID, because it's that disregarded, it flows through to the sole owner of that entity.
I think I followed 90% there. The new purchase still has to be on 100% by Ross Properties. It's not like you can have Ross Properties owning 70 and a new partner owning 30. It's still 100%. You just have to change the actual operating agreement.
Yes, but you could do the other thing you just said. So let's just say that you did want to acquire the new property with another person, entity, whatever, that was not included in your 1031. So what would happen is you would want to make sure that Ross Properties LLC acquires enough value in the new property to reinvest enough to maximize your 1031. And then whatever value is left over, that other entity or person could acquire. So you would be tenants in common, right? Something you'd want to be certainly somewhat knowledgeable as far as operating as tenants in common, truly tenants in common, and not getting deemed a new partnership. So you would work with your tax and legal advisors to make sure that that was documented properly and you operated in that manner and that you reported it correctly. But yes, either of those are possible, those scenarios that you just laid out. Yep. Gotcha.
That may went over some people's heads. It gets very confusing.
It does. And, if they have something where they think, gosh, maybe my scenario fits that, just call us. We're happy to do a consult and talk through your particular situation and see, what we can possibly do, give you some ideas, things we've seen others do, some strategies that might work for sure.
Yeah, this is great because, if you get it right, it can be very cool and you can, defer a lot of gains and save yourself money. But if you get it wrong, you cost yourself a fortune, literally a fortune.
Very
so
true.
Where would someone's listening to this, they need to talk to you. How do they reach out?
Sure. So you can call us. We have an 800 number. It's really easy. It's 800-828-1031. Or if you want to pop onto our website, which is simply 1031corp.com, just 1031corp.com. All our contact info is there. That 800 number is there. So we're always happy. You can fill out a form and we'll reach out to you, or you can call us and we're happy to chat.
Awesome. Well, I appreciate all the time and the brain energy that you spend walking through these conversations. I mean, this is, I'm a nerd. I like to nerd out about this kind of stuff. This is an exciting conversation because it's people's businesses and lives. Like, people make major decisions involving this kind of this strategy. So this is the first time I think I've ever had someone break this down like as in depth as you had with examples and numbers and all that. So it's very helpful. I think people are going to find a lot of value.
Absolutely.
Yeah.
Absolutely. And we have, that this can benefit someone, help you build that real estate portfolio, right? Build that wealth, use your pre-tax dollars, make it all work for you, get to those investment objectives. And 1031 still going to be around for a long time. That's our our hope. We're making sure of it, right? Our industry is making sure of it for sure. So
I think so. It accounts for way too much, I would think, way too much of, tax revenue dollars in the U.S. for them to kind of nix it. Yeah.
It does. Yep. Yeah, it mathematically doesn't make sense to get rid of 1031, and we're lobbying to make sure of it. And we were not part of the Tax Cuts and Jobs Act, so we don't expire. We've been in the tax code for over 100 years, so I don't think that we're going anywhere.
Awesome. All right, folks, there you have it. Marissa LoCascio, 1031 Corp. Thank you so much for watching. Tune in for the next episode of 80/20 Rockstars podcast. Thank you.
Thank you, Rodney.